All right, joining us now on the stock side, we have Dennis Gartman, editor and publisher of the Gartman Letter. We have Ken Hebner again. We have Peter Schiff again, are still with us. We lost one casualty down in Fort Worth. Maybe we'll get LeCamp back or not. Dennis Gartman, God, I love reading your newsletter every single morning. Let's do a quick whip around. Does the Fed action today, Dennis, guarantee, as much as anything can be guaranteed, that November 20 was the bottom in stocks?
I think it does, Larry. I think they've done exactly what they needed to do. I understand the concerns that they may be a bit overstimulative. I know that Peter Schiff is not going to like that comment, but yes, I think they've put a bottom into the market, and I think they've guaranteed that the October and the November lows are now finite and will not be taken out.
All right, Peter Schiff, it's the one thing I didn't ask you in the Fed segment. Is there a stock market bottom now?
I doubt it. But even if there is a nominal new low here, there is not a real new low. If you price the Dow in gold, if you look at where it is right now, the Dow is barely worth 10 ounces of gold. We're right on the lows for the move. My guess is by next year, the Dow is going to trade down to only 7 ounces of gold, maybe even 5 ounces of gold. That would be a 50% decline in the real value of U.S. stocks priced in gold. Who cares what happens priced in dollars? Because we're putting those into oblivion.
All right,
I live in dollars.
And
not for long.
Let me get my friend Ken Hebner. Ken, again, this is a whip around. We're going to come back. You mentioned in the earlier segment when we soloed you, you like financials and insurance. Ken, just real quick, the second-rated group today, which did very well, was basic materials commodities, and the third was consumer discretionary retailers. A quick comment. Basic materials, Ken.
Okay, I think that the global recession is going to take us to levels where we have a surplus of commodities for several years. Commodity stocks, including oil, are not attractive.
And retailers. How about retailers? If you are right on commodities, Ken, let's assume commodities keep falling. We've seen a tremendous retail gasoline drop, which is very bullish for consumers. Would you buy retailers and consumer discretionary?
Well, I think a year from now, the consumer is going to be growing. Consumer spending will be rising in the year 2010. It could even happen before that.
All right.
So there will be opportunities in retailers.
It's all going to be for food and energy, though.
All right, hang on. We're going to come back. I got to jump. We're going to come right back. Please stay where you are. I want to walk through some of these key groups. I want to walk through some of the logic. And I want to ask, by the way, does anyone want to cut tax rates? This is all demand-side stimulus, big government stuff. That doesn't produce productivity or growth or investment. CNBC reports coming right back. I'm Larry Kudlow. Straight ahead. All right, we are back. Dennis Gartman, Ken Hebner, and Peter Schiff. Dennis, I want to go back to a mustard seed here with the plunge in gasoline prices. You see it in today's consumer price index. This is the third straight decline, minus 10% last 3 months. And it's only rising at 1% for the past 12 months. Now, Dennis, here's the gig. We're going to put it up on the screen. This is a big tax cut for consumers. It's a mustard seed. Real average weekly earnings are now beginning to rise. They're up over 2% in November. If I use the Labor Department's unemployment, the average hourly earnings, those were growing at 3.7% nominal. If you take 1% off for the CPI, suddenly they're up about 2.7%. Now, could this have been one of the reasons why we saw a little better core retail sales? And maybe people are just too darn pessimistic because they're not listening to my mustard seeds.
Well, I think this is a very good point that you make. I mean, this is really a huge tax cut for the American public. And what you also have to take into consideration, Larry, I find it fascinating that as gasoline prices have fallen by 75%, if you look last month, usage of gasoline, which you would expect to have gone up, is still down another 5% on top of it. It is as if the American public has said, you know what? I saw $4 gasoline. I've learned how to do with less. I am, in fact, using less. I think that's really important. So you have a double whammy. You've got an increase in income. You have a decrease in the cost. And you have people actually using less. The savings rate in the United States is about to go skyrocketing. Well,
I guess when you have no job, you don't use that much gas because you don't have to go back and forth to work anymore.
Well, Peter, that's not what's happened. I mean, unemployment is obviously rising, but it is not anywhere near what we saw in 1973 and 74, and it's not anywhere near what we saw in the 1930s. So come on now.
I think you're seeing a decline in the standard of living, and that's why people are consuming less.
But Peter Schiff, can I sell you a couple of mustard seeds that may grow into recovery trees commodities, if only cyclically. I mean, the consumer price index coming down. It is following the retail gasoline and the energy. But you know what? It's across the board. I mean, the core CPI, take out food and energy, the core CPI has come down. At least on a cyclical basis, Peter, this is the kind of thing that the pessimists won't look at. It could promote a much stronger 2009, and the stock market will discount that ahead of time.
Not a chance, Larry. And, you know, I don't give a lot of weight to these government measures that purport to measure the effects of inflation, you know, in prices. They're all meaningless, I think. I think we got to really look at what the Fed is doing with his balance sheet, with money supply, watch the exchange rate of the dollar, watch the price of gold. You want to know what's going on with inflation, don't look at these government numbers. And as I said, I do acknowledge that there have been some falling prices recently. This is temporary. And again, prices rise and fall as a result of inflation. So to see prices coming down and think, oh, there's no inflation. No, there's plenty of inflation. It's the forces are just being held at bay right now because other factors are stronger. But these are temporary factors.
On the way out, Ken Hebner, do you fear inflation, and what do you think about the possibility that the energy and retail gas tax cut could give us a more promising profits picture as well as a consumer picture?
For the next several years, there's not going to be an inflation problem. We are rapidly bringing the global economy to a level where there's a surplus globally of labor and raw materials, which no matter how much growth we have in 2010 and 2011, the pricing level globally is going to be in a downtrend.
And so that is the reason why you're staying away from the basic materials. Is that fair,
right,
Ken?
That's right. However, I want to point out, between 1870 and 1900, we had great global growth and a declining price level. Let's not get deflation and growth confused.
That's because we had sound money back then. We were at a gold standard.
Hang on. We're going to come back, gentlemen. Please stay where we are. We have more work to do, and I want to talk about some of the sectors that rallied today on the Bernanke announcement. Coming up, it looks like SEC Chairman Christopher Cox has awakened from his deep sleep. He may have been listening to our own Charlie Gasparino, as we all must. Charlie has the latest on the Madoff scandal when CNBC Reports continues. Stay with us. Christopher Cox, back from the dead. I'm Larry Kudlow. We'll be back after this.